Wondering what 2024 has in store for the real estate and economy? Hang tight. We're going to review 2023 and find out exactly what happened in 2023 and what it's telling us about 2024. So hang tight. Hey everybody, Tom Townsend with Keller Williams and Townsend Realty Group. Hey, one of the great things about being an agent with Keller Williams is we've got so much data and so much input that our brokerage actually puts together for us to be able to take, analyze, and then bring that back to you and share with our audience and our clients. So today's going to be kind of a lengthy video that we're doing. We are going to go back and look at 2023 and a couple years before that to really dive in and tell what is the story is that the information that we have about the real estate market is telling us about the market and help us to predict what's going to happen in 2024 and beyond. So in order to do that, we're going to dive in to a lot of slides. I'm going to show you some slides and kind of go through those with you and show them one by one. So that's what the goal is for this video, is to really just, it's a market update of what happened in 2023, and let's see what's going to happen, see if we can make some predictions. So jumping into this, here's some key indicators. We're talking about real estate right now, and these are national numbers. Now I'm going to kind of talk a little bit about what's happening here locally in the Atlanta market as we dive into this, but just kind of keep in mind that these are national numbers. There is no national real estate market. Real estate is very local. However, that being said, the national numbers are really beneficial for us to take a look at. Most of this information is pulled from the National Association of Realtors, which does a fantastic job compiling a lot of data for us. And then, of course, there's some other resources that are used. So this is not Tom Townsend. This is not Keller Williams necessarily data. This is all national stuff that comes out of the National Association of Realtors. So here are the drivers for the U.S. real estate. We're going to take a look at the 7 key drivers that indicate what's going on in real estate itself. So one of the first things that we take a look at, let me get me pushed up here, is home sales. Now, interesting, when we take a look at what's going on with home sales, these are annual home sales. I can't get my mug out of here. There we go. Let me just make an adjustment here. Hang with me, folks. There you go. These are the numbers of actual sales that occurred. So when this says 4.3, that's 4.3 million sales that actually are projected for 2024. So this is just kind of interesting. It kind of tells you just how much volume, how much transactions is actually occurring out there. This was the run-up that we had up until the pandemic. You can see that it was increasing. And then, of course, there was this big drop-off in 2020 when the pandemic hit. I'm sorry, I was gonna say, wait a minute, that's not right. Actually, it was a big run-up. In 2020, it was actually still pretty good, but the year that we came back, 2021, was almost a record year for us. So that was a big push. That was the big influx. If you were out there as a buyer back in 20 and 2021, you felt that. I mean, it was very, very competitive. And then we had a drop off in 22, and then even a further drop off last year in 2023. So this volume right here, this is actually pretty dang low. That's a low volume, especially because our population is growing. We have more buyers out there. The projected for this year, there's been a lot of critics of this. They're saying that it's not even get close to 4.3. They're hoping that it's going to be maybe the same as last year, 4.1. Some people are even predicting 4.0. So not a very robust market moving into 2024. Just not a lot of transactions occurring. So this is kind of interesting to kind of take a look at. And then we break it down into monthly. This was the monthly occurrence last year. This is actually 2022 and 2023. So you can kind of compare to what's going on. Really kind of surprised we had that many sales in January in 22, in February and March. Wow, that's a lot. Um, so it is adjusted. Oh, it is adjusted seasonally. That's why. Okay, so this is adjusted seasonally. So it's going to take this big hump out that we see during the summer months. Now, this is national. We don't have that big of a hump here locally in the Atlanta market like they do nationally. Like, just think about the northern states. There's just not a lot of stuff going on during the winter months. It's all their market's all summer. We have a little more flatlined as far as seasonality. But this kind of shows you, month to month of what's going on. 23 was pretty flat across the board. We didn't have a big bump whatsoever, but it was consistent. There wasn't like a particular month that was just like a drop off or a pickup. So just kind of interesting. You can see the slowdown as 22 was occurring throughout the year. That's when the rates started going up in the beginning of 2022. And so the average sales were decreasing pretty steadily, but this kind of shows us that it's plateaued off since the end of 2022. So it's been pretty steady across the board. So that's what I read into that. So we're not decreasing like we were back in 2022. All right, let's take a look at home prices. This is a great slide because I actually use this in a lot of my listing presentations and with my buyers as well. Listen, there's so much misinformation out there as far as things being way overpriced and this is crazy and they've got to come down. But historically, we can kind of take a look at what's going on with home prices. The average home price historically is 4%. All right, so this trend line is 4%. And if we just continue to follow that up all through here, you can see what happened back in the Great Recession, back in 06, 7, and 8. We ended up about 24% above that trend line by 2006. Now, we had a lot of really shaky financing going on back then. They were really loose with their lending requirements and they were giving money out like candy, right? If anybody was around back then, you kind of remember that, which ended up causing this big drop off. That's what started the recession itself, was all the defaulted loans that we had out there. But it was already way above that trend line. So there was a big fall off. And there's some other reasons that we may get into a little bit later of why it fell so hard and so fast. Basically because we didn't have anybody coming in quick enough to be able to help stop this drop. The federal government basically just they didn't come to the rescue fast enough. But eventually they did, and it started to plateau. But here's where a lot of people are feeling pain. We were below this trend line for almost 20, 15 years. And then in 2021, look at this jump. We went from here to here in 1 year. This was a huge appreciation year that actually went below the line to way above the line. And then it continued to go above the line for the last 3 or 4 years. So this is why people really have exaggerated the fact that they think the market is way overpriced. I have countless conversations with people saying, man, this market is way overpriced. We're still only 9.3% above the trend line, far below the 24% that we were back when it crashed. All right. So we do have some adjustments going on. So the government reacted much quicker this time because they don't want this to happen again. And they went in and they reduced rates, which slowed this huge increase in this influx up. It slowed it down, and we're going to see in future slides here that it actually has plateaued off. So now, we got two choices. Either it's going to have to come back down, or we have to wait it out for this trend line to kind of catch up to where we're at right now, or a combination of the two, which is kind of what most experts are saying, that it's probably going to be a combination of the two. Maybe kind of keep this, hopefully this will steady and plateau off and we won't see this crazy appreciation that we have and stay below 4% a year for a couple years until this line can kind of catch up with us. But this is a really good slide to show that we're not crazy overpriced. Now this is national, all right? Again, this is national, it's not regional, but I will tell you that the Atlanta market, when we look at it, is very, very close to this. So not that much far off. So this is a good slide. Um, this is kind of interesting looking at when appreciation has occurred, what years, and how much it occurred. So you can kind of see back in 90 to 2000, pretty steady, 3.9. That's right on that trend line we were just talking about. This is when it started getting crazy, is back in '01. I will tell you, just based off of history, this is when they started loosening up lending guidelines, and everybody was getting a loan and they were handing it off to people that didn't even have jobs and the whole bit. And that's what that run up was. All right. And then what hit the fan, and everybody started, not everybody, but a lot of people started to default. And then it just kind of, the cards just, it just fell apart on us. So you can see that we lost a lot of that appreciation in those years until about 2011, and then it started kicking back in again as we started to become healthier. Now we were so far behind that trend line, we had a lot of gap to make up. So this was actually good that we started to see some of that appreciation to make up the difference. You got to remember, naturally, if you're a statistician, if you know anything about stats, that trend line is like a magnet that's going to naturally pull things to it one way or the other. That's what creates the trend line. And then here's what happened during the pandemic, right? Everybody got a check, got a government check, and everybody had money to spend, and that's what really fueled not only the real estate market but everything else too. And that's where you saw these huge jumps in appreciation during those years, 20, 21, 22. And this just is not sustainable. So this is when 2022 is when the rates started going up and the feds jumped in and they said, we got to slow this thing down. And they did. They did. They pulled it down. They definitely don't want to get into an issue where we're starting to lose appreciation or devalue it, but getting this down to as close to 1 or 2% as they possibly can would be optimal in regards to what the federal government would like to see. And so far in 2023 and 2024, that's what we're seeing. Now, I had a conversation with quite a few folks, and I don't know where they're getting this info. Again, this is national. Georgia is following along this trend line pretty much to a T. But I've had conversations with a lot of folks, and they've mentioned to me that they've been hearing that we're actually losing value in the local area. We don't see that. And I don't know where they're coming up with their data. I asked them, I'm like, where'd you hear that from? Where'd you get that from? And they can't really tell you. So I don't really know where people are pulling that from or where those stories are coming from. But just understand that overall in the Atlanta area and even nationally, we're still seeing some appreciation in housing, just not at the clip that we were, which is always a good thing. We just can't sustain this for much longer. So this is all good. This is healthy. So we're happy with that. Home price appreciation. All right, so here it is, kind of the same thing on a graph. What we pulled out of this was it's very interesting. This line right here, that's 0% appreciation. And we do have some periods over the decades in time that it hits zero. So if you look at every time this line hits zero and then look at the reason why it hit zero, it's very interesting to note that it is either a government influenced or a banking issue. So just really interesting. If you let just the market react and do its own thing without the influence of government or bank intervention, it'll probably just continue to grow. So here's an indicator. Here, let's talk about this. This is a Great Recession. Remember when I said they were a little bit too slow to react? The government was to jump in. This is what I mean, is that they waited too long until this thing crashed. And then by the time they did do something, it was too late and it crashed even further. No one wants to see this again. The feds don't want to see it. The banks surely don't want to see it. No one wants to see this. So that's what we made a lot of changes over the years since then to circumvent that. And that's why you saw the federal government react. When they saw this increase right here, that's why they reacted so quick with getting the rates, increasing the interest rates, the Fed rate, to slow this thing down. And you can see that it just touched that bottom and then started to come back up again. So this was good. This is good. We didn't see this, which is what we don't want to see. But it is kind of interesting to note that it's either a banking or government influence. So watch those two things, right? If you're really interested in this kind of stuff and you really want to watch, see how healthy the banks are, and watch government influence on your interest rates and some of the um, policies that they're actually passing as it relates to the economy and real estate. All right, this is overall volume. Is this dollar amount? Yeah, this is dollar volume. So this would be the value of property being sold. So you can see once again that this trend line continues as appreciation increases. Obviously, um, uh, the value of a property is going to increase. So naturally, that is going to jump up. You can see in 2021, this was caused due to just the volume that we actually had. There was a lot of people buying and selling properties in 21. That was coming out of the pandemic. You had government checks, and people were pent up for a year and they were ready to do something. You had companies that weren't requiring you to be close to the office anymore, so people were moving out. There was a lot of movement going on in 2021. And then that kind of started pulling back, and then we settled in at 2.09 in 23. And then we're predicting, once again, a lot of people are saying they don't think it's going to be that high this year, but we'll end up seeing. And then this is obviously the agent count. Obviously, people are going to follow money. People saw that agents were making a lot of money. They saw the opportunity there, so a lot of people ran out and got their license. So this is just kind of interesting. During the Great Recession, when things slowed down, a lot of people left, right? So a lot of agents actually left the business. So this is an interesting scale. This one is actually adjusted for inflation. So when you pull out the inflation, it kind of gives you a better baseline from a statistical standpoint. So here it is again. You can kind of just see the last couple years. Look at that. I mean, this is just a huge increase. Again, everybody was pent up in 2020. 2021, when things started loosening up again, people had money in their pocket and they went out and bought and sold. Same thing with the agent counts, the same. That's not going to change. So what do we see? We see a decrease in 23. That's driven a lot with the interest rates and the lack of volume as overall. And the prediction is that it's probably going to stay about the same as it was in 23 for this next year. This is a little optimistic. A lot of people are saying, yeah, it's not going to be that great. But it's not going to be drastically different than that. All right, inventory. If you really watch this stuff and study it, everybody's been talking about the lack of inventory in the market. This shows that. If you can remember high school econ class and the law of supply and demand, it is what it is, right? So the lack of supply that's available typically puts upward pressure on pricing because things become more valuable when there's scarcity. So that's where you've seen this huge increase in appreciation over the last 3 or 4 years, is because that inventory level has been so low. Even with the increase in rates, which pushes down pressure on prices, it's really a battle between rates and inventory right now, and who's going to win out between those two factors. And right now, it's kind of a balance. It's balanced its way out as far as the value of your property, the value of real estate. So we already kind of went through that there's just been a modest increase in value. So obviously the lack of inventory or the short supply thereof is battling a little bit more, battling out its winning a little bit. But this is kind of interesting. You can definitely see when inventory goes down, appreciation is going to increase just because of the law of supply and demand. Mortgage rates. This is another slide that we use quite a bit. It's been, we talk to a lot of folks that although rates are what they conceive as high historically, they're really not all that bad. Here's where we have a problem, is really since like 2000, right? We've been on a 24-year run of super low rates. So we're used to these low rates. Most of us that currently have homes and have a mortgage are locked in at a really low rate, 3.5%. And to be able to trade that out, to sell that out, and then buy a new home at a 7.2%, which I think is where we're at right now, is very painful. So, because we have such cheap money that we're borrowing right now, that jump into a higher rate is painful. So, that's where a lot of people are locked into their houses. They're like, nope, I'm stuck, I'm staying here. So, that's where a lot of the pain is. But historically, when you look at rates, it's pretty much on par. It's pretty average for where we should be historically. Just another note, back in the 80s when it was 16.6, I'm sure anybody that has people living um, in that era, they're always telling you how awful it was back when they were buying a house. So, anyways, just another little tidbit. um, anyways, there's your mortgage rates. And then, of course, we broke it down per year. I'm sorry, per month, for almost like the last nine years. So this is where we're at. This is the pain. Look at this. We're just cheap money. Look how cheap this was for so long. Look at this. All right. Fun story. In 2020, when the pandemic hit, we all, everybody panicked. We've never been through it before. So there was a lot of fear there. Man, I had so many conversations. People were like, no one is ever going to buy or sell a house again. There's no way it's going to happen. The rates were at 2.68%. Now, hindsight's always 2020. Wouldn't you have liked to have bought like 5 or 6 houses, rented them out at a 2.68% rate, and benefited from all the appreciation that happened over the last 3 or 4 years? I've said this, man. The folks that bought houses back in 2020, high five. You are doing very well. Good for you. Kudos to you for actually seeing that. But man, I had so many conversations with folks that just were not going to buy back in that 2020 and 2021 because they were just, there was a lot of fear. There was a lot of unknown there. So I got that. I really did. And hey, I shouldn't say that. I was going to say I was right there with them. So I got it. But man, I tell you, look at that rate. Whew. Hard to give up that 2.68 for a 7.2 right now. It's just not going to happen. All right. Treasury spreads. I have a hard time explaining this, but I'll do the very, very best I can. So when the Fed raises rates, it is not a direct reflection of the 30-year fixed. It's indirect. So basically this rate is, I'm going to try and put it in layman's terms. This is the rate that banks borrow money back and forth from each other and from the Fed. So that's what they get the money for. Then they put a margin or a yield on top of that in a 10-year Treasury bond kind of a deal. It gets a little complex, and that is called the yield spread. And that's basically the profit margin that they are looking at, that they put on top of that. That is based off of risk and risk assessment that they feel in the particular market at any given time. And it is market driven. So it's not like you've got some, banker back there and, well, I think it's going to be X amount. It's kind of market driven. Once again, I'm really, really trying to simplify this because it gets a little complicated and it gets over my head. But here's the news that I want to tell you. There's a large spread right now of 2.85% between what the banks can borrow and what the market is actually lending that money out for. So there's a fairly large gap here, as you can see. So some folks are saying, listen, we've got some room to get this thing down so it can come down without the Feds having to lower their rates or adjust their rates at all. If they just stay stagnant, there's still a large yield in there right now. So we're hoping that over the next, 6-9 months, people are saying there is some room to be able to get these rates down and have the market actually relax and not be so fearful, and relax a little bit and not have such a high yield rate. So I've heard anywhere from like 1% to maybe a little bit more that could drop down. So that computes to a current rate of 7.2, which is, I think, is where we're at right now when I'm recording this. And if there's a yield flexibility in there of a drop of another percent, that means that rates could come down to like 6.2. Okay, so that's kind of what that comes out to. So, anyways, that's what the yield spread is. We definitely take a look at this. This will tell you how much risk that the market sees in the market right now. And right now, it's saying that there's a lot of risk out there, and so they bake in risk inside the yield. So hopefully that was enough of an explanation of that. You can correct me if I was totally wrong on that. If there's some financial guys out there that, I got it totally wrong, please let me know. But that's how I understand it. All right, affordability. Here's another slide that we work with a lot of buyers on right now. Listen, millennials, you guys are always getting beat up, and I apologize. I've got millennial kids. I think it's just natural for one generation to kind of beat up on another. Listen, when you get a little bit older, and you're going to beat up on the generation behind you, so it's just kind of natural. We all kind of do it. Believe me, the generation ahead of me, they thought we were a bunch of yahoos and we didn't know what we were doing. So, anyways, millennials, I hear a lot of complaints that just unaffordable. You can't afford a house. No one's ever going to be able to afford a house. When we look at this, yeah, it's higher than what we typically would like to see, but it's not crazy outrageous. So the affordability rate is still halfway decent, maybe a little bit high. We would like to see it. I always like to see it right around 15. About 25%. Right in that area. That seems to be a comfortable area, about 25% affordability when we look at it. That'll tell you the cost of things associated with how much money you're making. That's the two factors that get plugged into this. So how much money are you making? What's your income? And then how expensive is housing right now? And those are the two factors that kind of make up this affordability number. And right now it's at 32%. The last time we were at 32% was 2006, right before the crash. But yeah, you go back to 81, which is your crazy family that always complained about your 16.6% interest rate. Well, that's why that was at 49. So that was a crazy time in real estate. But right now, yeah, do we need to come back down? It will. It'll come back down because that trend line is going to naturally pull it down. But right now, yeah, it's a little tough. It's a little tough right now. So again, going back to 2020, hindsight is 2020. No pun intended. But man, the affordability back then was actually pretty good. So sorry we missed the boat if you didn't buy back then. So here you go. That's affordability. We can definitely feel that. All right, these are numbers that drive the Canadian market. And we're not going to talk about Canada. Unless you want to talk about Canada, reach out to me. I'll be more than happy to go through those. All right, now we're going to shift away from just real estate, and we're going to take a look at the economy. Real estate and the U.S. economy are tied at the hip. Real estate has a large impact with the economy as a whole. New construction goes into our GDP numbers, not resale. So keep that in mind. That's always an interesting caveat to that. But these are the key indicators to really see how we are doing overall in the economy. And then obviously the story that these numbers are telling us, and being able to make as best predictions as we can for 2024. So GDP. Gross domestic product. This is how healthy, this is the overall arching indicator of how healthy the U.S. economy is doing. It happens to be the number that everybody seems to go to. The federal government would like to maintain a 2% GDP. That is their goal. Anything below that, we have deflation, which is not good. Things are crashing. Anything above 2.0, we have inflation, which is kind of what I'm going to go through this real quick. You can see right here, here's the Great Depression of what happened to it, and the economy fell apart on us and then rebounded fairly quickly, but was pretty steady by plan coming out of that. So here's the pandemic. We lost 2.2% GDP in 2020. But look at this rebound. This is the inflation that everybody is feeling right now. When you have a year coming back that made up not only that 2.2, but made it up plus some. This was all the government money that got pushed into that we all got, right? We had money, and the government pumped the economy back up. And then in 2022, it came back down to 2, which is their goal. And then in 2023, it jumped back up to 2.5. And I know that you're probably thinking, 2.0 to 2.5, that's no big deal. That's a big deal. That's a lot of money. All right. So just that little 0.5%, that has a huge impact on it. So the federal government is going to continue to put downward pressure on the government through rates and some other policies that they can make. They're going to have to start passing laws and stuff to do a lot of that fiscal policy um, um, apparatuses that they have, levers that they have to get that back down. But they're going to continue to push this down. This is not a number that they want to see, especially after 2 years seeing that. All right, so they gotta get that thing down. So what does this tell us? GDP is on fire. We had a huge influx of cash into the system, drove up interest rates, or not interest rates, but inflation big time. And we're going to continue to see downward pressure for the near future until we can get this GDP number back down. We look at it quarterly. I just think this is interesting. In 2020, here's the first hiccup that we had in that first quarter, that second quarter. Look at that. Boom. Everybody was home. This is when the world shut down right there. And then when we started coming back, boom, this is when everybody got their checks and we had all the money. People were back out and they were kind of starting to get back to normal. And then it just kept on going up. Look at that, 4.2, 5 point. I mean, this rally right here, this is your inflation. Bam, right there. That's where all that inflation. Then it pulled back. This is when they increased the rates right there. Pull it back, right? So they put the brakes on, and then it still kind of bounced back a little bit. And then they've been struggling with it ever since. They're still struggling, trying to keep that thing down. So this is kind of an interesting slide. I kind of like this. Okay, growth versus home sales. All right, home sales is a leading indicator for GDP. So many economists will look at what's happening in the home sales to predict what's going to happen in GDP, because home sales has a large impact on GDP. So it doesn't, I kind of looked at this and it doesn't look like it follows it to a T, but you can see, all right, well, this is existing home sales. All right, so you can see when home sales decreases, shortly thereafter, now it's usually like a year, it's not a couple days, it's not immediate, but like a year later, you'll see that decrease in sales actually show a decrease in GDP. So here's a decrease in sales for this period, 97 through 2000. You can see the GDP slowly came down. You can see it bounced back, and then GDP slowly came back up. Now GDP, because home sales is one of many factors in GDP, it's not going to be the same kind of volatility here. It's going to be much more subtle, but you can still see the trend. So here's where it came down. This is the Great Recession. And then you can see GDP followed that. Now, federal government does not want this thing to get below zero, because that is all kinds of other issues. So this is when I talk about the slow response. This is kind of what happened, and GDP kind of fell below zero. We do not want to see that again. Then it came back up, and you can see GDP slowly came back up later. Didn't really follow here. This was pretty stagnant, but you can see this fell down here. This is late 2018, 19. It fell down, and you can see GDP fell down. Now this is 2020, so that's where it went below zero. But you can see that it went back up right here, and then it kind of climbed back up. Okay, so here's where we're at now. And this is where it's got a lot of people stumped. So we see this big, huge drop since 2020, 21, 22, this big, huge drop. So we can anticipate that probably over the next year or so, this GDP number will come back down if it's still going to follow this trend line. The question is how far is it going to drop? We do not want to get it below zero. So it's a balancing act. The feds are going to have to really take a look at this and and do the right thing in order for this right here. I know this doesn't look like that was very significant, but coming below zero is pretty huge. And this was the shutdown, right? So that whole shutdown that we all impact, shutting the economy down for a whole year, just that little teeny blip right there. So I know it looks minor on this graph, but that's huge. So we don't want to see that again over here. Okay. So, anyways, this is going to be interesting to kind of watch and see, and to make sure it's a balancing act to make sure that we continue to keep things pumped up enough where we don't below that zero. So, just kind of interesting. Very interesting. Unemployment, I don't know if there's a lot to talk about here. Listen, our unemployment nationally and here locally in the Atlanta area is really good. I think it probably is a little bit lower than that. I think we're beating the unemployment rate on a national basis. I can't remember. But the good news is, listen, there's jobs. There's jobs out there, and we don't predict that that's going to change a whole heck of a lot. So that's good news. So employment is a big indicator on the U.S. economy, and we seem to be doing okay. And this is this the same thing, just a line? Yeah, it's just the same thing, same stat, just a line. Okay, so unemployment's good. Here it is on a monthly basis. You can see it's steady Eddie. Obviously, 2021, everybody was coming back to work, and we slowly filled up the jobs again. And then by the end, the middle of 2022, boom, we were plateaued off, and it's been steady Eddie ever since. All right. Personal savings rate. All right, this is kind of concerning. This has got a lot of people concerned. Millennials, I'm going to pick on you again. Interesting that saving rate, this was the saver generation, right? The 50s, 60s, 70s. This is the generation that just saved their money. They were big savers. And then something happened in 1990 and beyond that the saving rates, well, first of all, life got expensive. This is where you started seeing the need for double income homes. No longer could you sustain, what you felt comfortable with a single home, paycheck coming into the house. Plus, they were saving. Not only did they only have one income coming in, they were saving so much money, right? So there was a drastic shift that occurred. So without getting too much in details, here we are today. Back in 2005, this is right before the Great Recession. No one was saving it. I mean, this is talk about living paycheck to paycheck. This was it, right? Back in those days. It came back up after the Great Recession, but it never has really rebounded. Now, most financial gurus will tell you at a minimum, you need to be saving 10% of your gross income. So that's not net, that's your gross. So if you're making $50,000 a year, you need to be saving $5,000 a year, minimum. Okay. Some people, I'm part of the KW Wealth community, and we talk about building wealth and all this other good stuff. Our goal is 20% of our gross receipts. So that's kind of what our aspirations are from a savings standpoint. Now, let me define savings for you too. This is not a checking account or your savings account. These are investments. So this is stocks, bonds, partnerships, joint ventures, whatever you want to do. Maybe savings. Some people have whole life insurance, dividend paying out, whole life insurance policies that they use, whatever it happens to be, but you're pumping money into some kind of a savings or an asset, maybe another business, whatever you happen to do. So this isn't like a savings account. However, this is really concerning because what we're finding is the millennial generation is saving very, very little of their money, very little. That is going to come back to haunt you. I know when I was younger, I didn't think about savings and retirement and my health. I mean, none of those things were a concern until I was about 55. And then all of a sudden things started getting serious. And, I'm like, holy smokes, things change. And believe me, and I'm going to show you in a couple other slides, I think they're in here. just why that is. Things are getting very expensive, and if you don't have enough savings and assets that are generating income for you when you get into your later ages, I don't know, it's going to be pretty tough. Um, so I know that a lot of folks, I know my kids and a lot of the millennials that I do know, it's all about experiences. They love spending money on experiences now. That seems to be a trend. That's great if you can afford it, but man, you got to be able to be disciplined in that area. You can't just live paycheck to paycheck and travel all over the place and do whatever the heck you want. So, anyways, I'll take my dad hat off, but that's my 2 cents on savings rate. But this is concerning that we're not saving a lot of money. This 2021 number, I think that's a reflection of everybody getting government checks after the pandemic. So, and then it boom dropped right back down. So, anyways, okay, inflation. All right, so this is our lovely government always has to recalculate or come up with a different formula for inflation, primarily so the numbers look better for them. So we have a couple different inflation numbers that we actually track. So once again, we're trying to get to that goal of 2%. That's what the Fed is after. And you can see, we talked about this a little bit before, that right now it's a little bit high, but because of the policies and such that we have in place, they really are predicting that they're going to get this thing down to 2% in the next year or so. But it's going to take a little bit of time. We're not going to get there right away. So that's kind of what the projection is, and we feel like we're kind of on track for that. So that's all good things that are occurring there. All right, this gets back to what I was talking about earlier about saving. All right, so this is what you guys feel. We all feel as far as inflation, and there's two categories, actually three categories, four categories that we see that are really heavily impacted, and that is healthcare is through the roof. Look how expensive it is for healthcare. You've seen a huge inflation number, and then also school is through the roof. So Gary Keller was going through this with us, and he made the joke. He goes, "The last thing you want to do is go to college and get sick," which I thought was kind of funny. But it's true. And as you age, obviously you've got college, right? So if you go to college and get a degree, it's going to be expensive. But as you age and you get older and you have needs for medical services, you've got to be prepared for this. I don't know how long these numbers are going to be trending up. There's no way this is sustainable over the years, over the long haul. So they're going to have to start plateauing out a little bit. But man, you got to have some money together. And this is what I was saying. When I turned 55, started getting a little bit older, having to go to the doctor a little bit more often for a variety of different reasons, I was like, holy smokes, this is not cheap. So that was huge, a huge eye opener for us. And then the other thing is, I'll just tell you a personal story. My wife and I, we love to go out. One of the things that we really enjoy is going out to restaurants and eating out. This is one of the things that we like to do. And I've been complaining over the last few years, just saying, I can't believe inflation is out of control. And the reason that I felt that way is because food and beverage has gone up like 90%. And because that was such a large line item in my budget, that was a huge impact. So it felt like everything was super expensive. But if we cut that out and I was healthy and I didn't go to college and I didn't have to buy a house, and maybe I just kind of bought some clothes every once in a while and loved computers and programming and TVs, I probably didn't feel that much of an impact on inflation. I was probably like, it's really not that bad, because the majority of the money that I'm spending month to month is spent on all of these things that haven't had any inflation at all. TVs, computers, software, it's all actually decreased. So all of my habits and the money that I was spending on all these items that really didn't see a whole heck of a lot of inflation. So you're probably, it's all about perspective, right? Where do you spend your money? If you're in school and you're sick and you spend a lot of money going out to eat, you felt it. right? Your inflation numbers are like, holy smokes, this is crazy. But if you like computers and playing on games and software and TVs and kind of a computer person, you probably didn't feel it all that much. So, anyways, just thought this was an interesting slide. Consumer sentiment, this is just basically how people overall are feeling. The higher the number, the more positive you're feeling about things. Back in February 2020, right before the pandemic, people were feeling great. That's why that pandemic probably hit us so hard, because things were going so good. The consumer sentiment was 101. We haven't seen that forever. So we went from this high to holy smokes, the world's coming to an end very, very quickly. So it dropped down, kind of held in there, dropped out. I don't know what was going on in June 2022. I don't know what happened. Maybe that's when the rates increased. Yeah, that was about when the rates increased. All right, so now all of a sudden the feds are raising rates, the interest rates are going up, affordability issues, and then we just been kind of climbing out of that slowly but surely. This is the good news. I mean, January bumped up to 79, so that's pretty good. So people are settling in. Anytime anything is brand, this is a little psychology. Anything is brand spanking new, people clench up, they get a little bit fearful, right? Think about when the pandemic hit and everybody had to stay home and you had to wear a mask. And your immediate reaction was, I look so goofy in this thing. I feel weird. It's uncomfortable. I'm not going to wear it. I'm not going out with this thing. And then slowly we got used to it, right? And it wasn't all that abnormal. I mean, we still see a lot of people with masks on around here, and I don't even give it a thought anymore. So it just kind of become natural over time. So I think that's kind of what's happening here, is we're getting used to it. It's just going to take a little bit of time, and then we're going to roll out of this thing. We don't need to look at Canada. All right, I'm going to skip this. This is the game behind the game for agents and brokerages. Maybe I'll go through this a little bit, but this isn't necessarily anything that most people would be interested in. I just think it's kind of interesting because I'm in the game, right? This is sides per agent, so I'll kind of explain this here real quick. So a side is a transaction. So when you sell a house, there's two sides to every transaction. It's just like if you sell, if you're involved with stocks, you got to have a buyer and a seller for the stock that you're selling. House is the same way. So there's two sides for every transaction. So this is the average number of sides that a typical agent, an average agent, would make. Now this is an alarming number. Maybe I will talk about this. The average over time is 10. 10 sides. That's 10 transactions a year. That's not a lot. And it talks about, how there was an influx in agents during the boom, and then after the crash, they all fell out. And then lately, once again, people chase money, right? They see people are making money. So the last 10 years, there's been a huge increase in realtors. Hey, who doesn't know 3 realtors off the top of your head? You can't tell me that you don't know any. There's tons of us out there. There's too many of us. And this is what this is showing. So in 23, the number of sides that an agent would make on average is 5.3. That's 5 transactions a year. Now I will tell you, now this is national. In the Atlanta area, the average commission, I'll let you guys know this. The average commission, now this is gross, this is top line gross, this is let's just say $10,000. It's a little bit higher in the Atlanta area, but nationally, let's say it's 10 grand. So if you're selling 5 sides, that's $50,000. Now that's top line. That's your top gross, and that's not what you're taking home. You have cost of sales, you've got expenses. So any really good agent that's running an efficient and good brokerage or a business, at best, they're taking maybe 40% gross margin back. That's $20,000 a year. Now that's what goes in their checking account after taxes, in their checking account to pay for stuff. That's 20 grand. That's not a lot of money, folks. That's below the poverty line, I think. So here's the message. we've had such an influx of agents over the years. You need to interview them when you hire them. Make sure that they've got the experience and they've got the volume. Because I'm telling you, you're making $20,000 a year in your pocket. You're either doing it part time and you have something else going on and you may be making money and you're just kind of doing it, which is fine. But if you're living off of that, you are desperate. So you've got to really understand someone's motivation behind helping you is not necessarily putting food on the table. That's not the agent you want. You don't want these starving agents out there that are desperate helping you through one of the most complex and expensive transactions of your life. So, anyways, this is kind of an alarming number. Now, obviously, I think over the next few years, you're going to see a lot of drop off of agents. And the cream of the crop are going to rise. Those agents that are professional, they stay up with their education, they know how to market, they know how to sell, and they're running a business, those folks are going to survive. But if you don't have that value proposition, if you're just an agent that's been kind of out there winging it, man, those folks are, it's going to be tough for them. So anyways, this is kind of an interesting slide now that I look at it. This is volume. This is actual dollar amounts, volume. So the average agent, well, in 23 sold 2.7, almost $2.7 million worth of revenue. Now that's the value of the real estate itself, which is not a lot. It just is not a lot of money. It really isn't. Most really productive agents are trying to hit that every month, not annually. So I'm just saying, interview your agents. Price drops. You don't have to worry about that. New listings coming on the market. This is just kind of interesting. It just tells you that 23 was slower than 22. So nothing that we haven't already covered there. All right, this is kind of interesting. Distressed sales. These are foreclosures and short sales. Now, short sale is a sale that the owner or the seller owes more than what. They owe more than what the house is worth, and they have to call their bank and work out a short sale. In other words, pay them less than what they owe them. This doesn't go back to this is on the back end of the Great Recession. So you can see that it was super high. You can see it's been nothing. We have just very, very little foreclosures. And that is because people have equity in their houses because they ran up the appreciation and they're not underwater any longer. They've got equity. So if they do get into a situation where they have to sell the house for a variety of different reasons, they've got equity in there. They can put it on the market and actually sell it and not have to foreclose on it, give it back to the bank, or they have to work out something with the banks themselves because they've got equity in there. So this is all very good. I've had multiple conversations over the last couple of years with investors or people that are waiting for the foreclosure market to kick in. They're like, oh, I'm going to, they'll call us, hey, do you got any foreclosure properties? I'm like, nope, nobody does. So you can see that there are no foreclosures. So it's just not a market that has reappeared again, and we really don't want it to. So this is underwater. These are homes that sellers that owe more than what the house is worth. Kind of goes back to what I was saying up here. Okay. A lot of people were underwater back in the Great Recession. We just don't see it. It's not here. Right. So if you get in trouble, people have got to sell the house for a variety of reasons. Right. And when they're not ready, people have got enough equity to be able to sell it on the market and be able to, make some money on it. So they're not underwater. All right. Credit conditions. This is how hard is it to get a loan? Back in the recession, Great Recession, banks tightened up big time, right? It was almost impossible to get a loan right after the recession hit back in 2010. It was very difficult to get a loan. Then it loosened up a little bit. It was loosey. 2020, this was just a freak out with the banks. They didn't know what was going to happen when the pandemic hit, so tightened right up and then very quickly loosened up. All right. Once they knew the world wasn't coming to an end and we were all going to be okay, it kind of loosened back up for a while. This is when rates tightened up a little bit and they slowly started to tighten up back in 2022. And it's kind of increased a little bit since then. So kind of an interesting thing, but banks will tighten and loosen up their lending requirements based on economic conditions. What do we see future? Probably a continuation of kind of tightening up. I don't think it's going to tighten up any longer, but kind of stagnate. It'll probably see how this green area down here? We're probably going to see that on the red side up here for a little bit. I don't think we're going to see a big spike or anything like that and come right back down. So for what that's worth. These are new home starts. This is new construction. Just understand that we are very, very short supply of inventory across the board. Nationally, we are short supply here in the Atlanta area. Our population is booming. We have a lot of property that are getting old and being demolished and need to be torn down, and we need to replace those. So new construction, depletion of new construction is still very heavy. There is no quick fix to that. So we're going to be in a short supply of new homes for quite some time. Hence the reason when you drive around, you see all of these new subdivisions popping up. This is a direct reflection of what the market is seeing as well. So we see a continuation of new construction moving forward over the next few years. New home sales, what's the difference? New home starts, okay, so we started, these are like permits, right? So a builder goes out and gets a permit and they break ground. They haven't sold the house, but they broke ground. These are sales. So we just look at the ratio between what has been started and what is actually sold. And we just want to make sure that there's not a huge gap in between what is being built and what is sold. And there isn't, right? So builders are still being very successful in building their stock or their inventory of homes that they're actually building. So no new trends there. We see that continuing on. The rates have had a little bit of a hiccup for them, but they're figuring it out. I tell you, if you're a buyer out there, because of the lack of inventory in the resale market, you need to go look at new sales, new construction. There's some really good deals, and the builders are savvy enough where they're giving you incentives back, and they're also giving you incentives to buy down the rate in order to move their inventory. The resale market, the typical mom and pop person that's selling their house aren't savvy enough to be able to really buy down rates. If you got a really good professional agent that's representing them, they can kind of talk to them about the ins and outs and the pros and cons of that and be able to work that out. But typically, they are not. But builders are. So a lot of incentives on the new sale side, unless you have a really savvy seller / agent that's working with a resale. All right, student loan debt. This happens to be a lingering problem, right? Right, millennials? This is tough. I mean, this is an issue. We've got student loan debt that's way too high, and then the consumer debt on top of that is increased. I thought after 2020, when we all got our checks, this would really go down. All it did was it plateaued. It helped us maintain that. It didn't increase. It actually went down a little bit in 2022. Maybe that was a result of the money that we all got. But man, it jumped right back up this last year. So that's a little concerning. This needs to come down. We're going to continue to watch the debt, which is going to go back into, right here. This is going to go back into what your household debt service ratio is. This is a combination of how much money are you making and how much money are you spending, and it comes up with a ratio. And this is what lenders look at to see if you are approved for a loan, right? They look at your debt service ratio. This debt right here is a huge factor in this ratio. So the more money you owe and the more debt you're in, the higher your ratio is going to be, and you're not going to get a loan or a favorable loan. So we look at that to see how healthy the market is. Are people making enough money? This is fine. It's not fine. This is one thing. This is one factor. But hey, if everybody's income has doubled since it was like a year ago, then this is like, it's not as significant as it would be. But if your income hasn't increased and your debt load has, it's going to have a huge impact on this ratio. So that's what this ratio tells us, and just kind of gives us an indication how much of that is held in a mortgage, and then what other consumer debt do we have. So it's a little concerning that the mortgage rate, I guess, is kind of holding steady, yet our consumer debt's going up. So we're going to have to continue to watch. We don't want to get into this whole scenario that we were in back in the Great Recession. This is what we don't want back there. So, okay. All right, what kind of economic risks do we have moving forward into 2024? This is really good to kind of take a look at right here locally. Um, this is going to have a huge impact on us as well. So we always monitor these things. These are the gotchas and the things that can really screw up the economy itself and can mess up the local real estate. So the first one is ineffective governance. Are there slides now? Basically, that means is, we have a government that's not making any decisions. Nothing's getting done. It's gridlock. It's an election year, so if you watch the news, which is awful, by the way, in my opinion, you're gonna get two sides of the camp, right? I mean, they're both saying what they want to say and they're pushing their message out. And it's very confusing for everybody. There's so much misinformation out there. And it's confusing. Then we have government that's just gridlocked. I mean, not a lot is getting done. And we need to get some things done. There are a lot of things that need to get done at the government level as it relates to the economy and it relates to real estate. And that's a risk. The risk is nothing's going to get done. The things that remember when I talked about the Great Recession and the government reacted too slowly to that, and that was one of the reasons why it was so severe. Well, that's a risk now. It's like, listen, we may end up having to pass some stuff. We'll talk a little bit about that when I get in. I'm going to talk about commercial real quick. But that's one of the issues that we have. Global conflicts. We get sucked into a war or anything, who knows what's going to happen. That's a big risk, right? So hopefully we don't have further conflicts that are going to occur, because that's on many levels that's not a good thing. Financial system risk stemming from commercial real estate. Listen, commercial real estate's got some issues. A lot of that is stemmed from the way that we finance our commercial real estate. There's no 30-year fixed loan in real estate. They're typically a much shorter period, usually a 5-year loan with a balloon on the end, or the interest rate resets or goes into an adjustable rate. And a lot of those are going to be resetting here pretty quickly. And if we don't have some intervention from the government to work with the banks to be able to work that out, then there's a big risk there. Some of those loans may reset at a much higher rate, which could make a huge ripple effect through the commercial real estate. Now, from what I've been told, the government is aware of that, and they're working very diligently with working out they've already been doing some loan modifications and such at a higher level, but that's a big risk. And then natural disasters and weather events. Listen, regardless of where you're at with global warming or global change or whatever you want to call it, the reality is, if you look at statistically, our storms have increased in severity and in number. So the last few years, there's been some major disasters that have a huge impact financially on our economy, and we are not seeing any changes occurring in that whole area. So we really don't know how severe they're going to be or how expensive they're going to be, but that is another risk that we have to the economy. I'm not going to talk about luxury. We're going to skip the luxury stuff. It is kind of interesting. All right, let me touch on commercial real quick, because I think this is pretty interesting. All right, so office space. One of the issues that we have with office space is that they're already at pretty high vacancy rates, highest that we've seen in a long time. A lot of that comes from the pandemic, when everybody left, went back home, they started working out of the house, and then companies didn't require their employees to go back. So they didn't need all the office space any longer. Now, some of them are starting to go back to work and requiring their employees to go back, but not everybody. So there's a huge vacancy. Because of that, supply and demand, a lot of supply, there was downward pressure on rates. So we have declining rates in that space. The most pressure is on the Class A space, and that is because if you are if you are an office space renter, if you had a bunch of office space, and Class A is like top of the line, Class B is mid, and then Class C is kind of low end. But the Class B people saw the rates at Class A were so economical, they're like, hey, we can pay the same amount and get a Class A office. So that's what they're doing. They're moving up. Everybody's moving up. So the lower classes, like that Class C, is really going to start showing some pain as far as vacancy, and even in the Class B. We're predicting that the Class A is going to get filled up first, and then the B's and C's are really going to be hurting there. And then here it says the commercial debt in 4 years. That basically is the reset of all the commercial debt on the office spaces out there. There's $2.8 trillion in commercial debt, and that's all going to be due in 4 years, or it's going to reset at a higher rate, or it's going to have to get refinanced. And when you refinance, you're going to be they're giving up their 5% rate for a 10% rate kind of a deal. So that's going to be kind of painful. So that's going to be interesting to see. Multifamily, there's downward pressure. We have had a lot of construction in multifamily. Once again, just drive around Atlanta. There's apartment complexes going up all over. And because of that influx of supply, it has pushed down rates a little bit, but not anything that didn't need to happen anyway, because it's gotten really expensive over the years to rent. Specifically in the Atlanta area, our rents got really, really high very, very quickly. So this is kind of a good thing to kind of push those rates down a little bit. Retail, there's a bunch of stuff going on in the retail market. The malls, the large malls, I mean, they're shutting down, they're closing down, they're repurposing those now into this consumer experience spaces. I don't have a good example of what that might be off the top of my head, but they're repurposing a lot of the retail space. So it's turning into something different besides your traditional retail store. So there's a lot of changes that are occurring at the retail level. Those vacancy rates, because of that, are decreasing. One of the other trends that we're seeing in retail is because of the issues that we have with theft in retail. A lot of the larger retail stores are actually removing product from their stores, and you're going to go in and you're basically going to see a virtual image of the item itself, and you're going to have to order it right there, and then hopefully by the time you get home it's going to be sitting on your doorstep. That's kind of the trend that's happening. So a lot of the inventory is disappearing from the retail stores, and which means you don't need as much room, right? So that retail space is going to change. I don't know how you do clothes that way. I can't imagine that you're going to have to do that in the clothing stores, because you still got to try stuff on, right? Look at it, touch it. But if you're going to CVS and you got like a bottle of aspirin, I mean, I don't need to see the bottle of aspirin. I would just get that on Amazon anyway. I don't know if I'd go to the store. Anyways, retail space is going through a lot of changes. It's kind of interesting. And then industrial, that's probably the most stable area of commercial that we have right now. Got a slight pullback after the surge in the pandemic with e-commerce, but not a whole heck of a lot. So that's probably the most stable out of all of those. So that's kind of the commercial. That's kind of how we see commercial happening in 2023, and some of the things that we can predict in 2024. Multifamily unit starts. Once again, this is kind of the apartment complexes that we talked about. I'm not really quite sure what this is trying to tell us, but okay. All right. Yep. A lot of apartments going in. Commercial loan delinquency rates still super low, right? Commercial folks are still paying their bill. It may change a little bit when we get to this 4-year mark. Wherever that 4-year mark was, remember when we talked about this 4 years, it's going to reset. It'll be interesting to see when those rates change, if this ticks up. So they're going to have to figure that loan stuff out with the commercial loans. They're going to have to figure that out, which goes back to, government's going to have to intervene. All of this stuff, all the rest of the stats are really geared towards agents and brokers, and kind of talking about where buyers come from and what are they looking for, and where sellers come from, and so I'm not going to go through that. All right. If you want to talk about it, reach out to me. I'll be more than happy to talk to you about that and share all that information. It's kind of interesting if you're really into that, but if you don't really care about all that stuff, I'm not going to go through it. So hopefully this was helpful. I will be more than happy to talk to anybody about this in more depth if you have any questions about it. Hopefully this gave you a really good snapshot of what 2023 looked like in the real estate market and also the US economy, and use this information. It's telling us a story. We use data to tell us a story. What is the story that it's telling us? And then be able to use that data and predict what's going to happen in the future. So here's the gist of what we see. We see a continuation of a fairly strong real estate economy in the local area here in Atlanta. The last 3 or 4 years were such on fire. We're going to see a pullback from that. We already saw that in 2023, and a continuation of that pullback. I think it's a healthy pullback from where we were at. We're not going to see a decrease in appreciation of our homes. I see a slightly increase, maybe a 2 or 3% appreciation in our homes, which is nice and healthy. The rates may come down a little bit later this year, maybe because of that yield spread. We've got a big yield spread in there, so there's a little wiggle room in there that I think that the market will naturally kind of give up, and those rates will naturally come down a little bit, but nothing drastic. We're not going to be down to 3, 4, or even 5% anytime soon. So let's get over that. That's kind of the reality of it. Buyers, there's still a lot of buyers out there. If you're a seller, there's still a lot of buyers. There's actively people looking for homes. So it's still a seller's market technically, and that's going to continue into 2024. We don't see any hiccup there. Buyers, there's not a lot of inventory out there. Look at new construction. Get with a great agent to find a retail. You're going to have a hard time or a harder time finding a home. You got to be a little bit more flexible with that just because of the lack of inventory, but it's still out there. So deals are out there ready to be made. Again, like, subscribe, do all of those things so I can continue to get this great content out to you. Reach out to us with any questions. And again, thanks and hope everybody's having a great day.